Silver touched $82 an ounce in Asian trading hours. For exactly 47 minutes, the spot price held above the psychological barrier that analysts have been tracking for weeks. Then it pulled back to $76, where it's trading right now. Most investors watching that move saw a failed breakout, a false alarm, another reason to doubt the rally that's been building since March. But there's a specific pattern forming on the 1-hour chart that tells a completely different story, a pattern that last appeared in this exact formation during April 2011, right before silver went from $38 to $49 in 11 trading days. The same pattern showed up in September 2010, preceded a 47% move in less than 8 weeks. And here's what matters. This pattern doesn't appear during normal market conditions. It appears when institutional positioning reaches a specific mathematical extreme, when the professionals are trapped on the wrong side of a move they didn't see coming. If you're holding silver right now and wondering whether this $82 spike was the top or just the beginning, the answer is hiding in plain sight on a time frame most investors aren't watching. Once you see what's actually forming on this chart, the $6 pullback from $82 to $76 stops looking like a reversal. It starts looking like the final compression before the real move begins. I'm going to walk you through this pattern step by step, show you exactly what to watch in the next 48 to 72 hours, and give you the specific price levels that will tell you whether this setup confirms or breaks. Stay with me because what I'm about to show you doesn't appear in the mainstream analysis, and by the time it does, the opportunity will already be gone. Welcome to John Asian Guy. Hit that subscribe button and turn on notifications so you don't miss what happens next, because in setups like this, the window moves fast. Now let's get into it. Let me start with exactly what happened in the markets overnight, because the headlines don't capture what the chart is actually telling us. Silver opened Sunday evening futures trading at $75.80 per troy ounce. By spot, silver hit 82.14 on the Singapore exchange, a 7.9% move in less than 6 hours. Volume spiked to levels we haven't seen since the March panic when silver first broke above $70. Then the price reversed, hard. Within 22 minutes, silver dropped from 82.14 back to 78.30, a 384 collapse on equally massive volume. By the time New York opened this morning, silver was trading at 76.15, almost exactly where it started. Now here's what makes this morning's move different from a normal spike and reversal. The structure of the move wasn't random. It wasn't news-driven. There was no major geopolitical headline, no Fed announcement, no supply disruption report. This was a technical move, pure price discovery testing a specific resistance level. And the pattern that formed during that test is what changes everything. On the 1-hour chart, silver has been building what technical analysts call a bull flag compression pattern for the past 11 days. Let me explain what that means in simple terms. Since May 4th, when silver pulled back from $79, the price has been making higher lows and lower highs, each swing getting tighter. The range contracting. Picture a coiled spring getting compressed further with each passing day. This morning's spike to $82 was the spring testing its maximum compression point. The pullback to $76 is the spring loading one final time before it releases. Now I know what you're thinking. Every YouTuber shows you a pattern and tells you it's going to explode higher. Then the pattern fails and the chart rolls over. I get it. I'm skeptical of pattern trading too. But here's the difference. This specific pattern, at this specific position on the longer-term chart, has a historical win rate that's impossible to ignore. And the fundamental conditions underneath this pattern make it more than just lines on a chart. Before I show you the pattern itself, drop a comment below and tell me, did you see that $80 spike this morning? And if you did, what was your first reaction? Did you think breakout or bull trap? I genuinely want to know how this community is reading the same chart I'm analyzing. Now let me walk you through what's actually forming on this 1-hour chart, because once you see it, you can't unsee it. Pull up any charting platform, set silver to the 1-hour time frame. Look at the period from May 4th to right now, May 15th. You'll see a clear pattern. First, the initial impulse move. Silver ran from $68 on May 1st to $70 on May 4th. That's an $11 move in 3 days. Strong momentum, heavy volume. That's the flagpole. Second, the consolidation channel. From May 4th to today, silver has been trading in a tightening range. The highs, 79, 78.20, 77.80, 76.90. Each high lower than the last. The lows, 72.50, 73.10, 73.80, 74.40, 75.20. Each low higher than the last. Draw a line connecting those highs. Draw a line connecting those lows. You get two converging trend lines forming a symmetrical compression. That's the flag. Third, this morning's breakout attempt. Price spiked above the upper trend line, tested $82, then pulled back inside the pattern. Now here's where most pattern traders get it wrong. They see a breakout attempt that fails, and they assume the pattern is broken. They sell, they move on, but that's not how institutional accumulation works. When a compression pattern like this forms after a strong impulse move, The first breakout attempt almost always fails. It's designed to fail. Why? Because the professionals need to shake out the weak hands before the real move begins. Think about it. Every retail trader watching this chart saw the same breakout to $82 this morning. The ones who bought the breakout got stopped out when it reversed. They're frustrated, they're cautious, they won't buy the next attempt. That's exactly what the institutions want. Reduce competition when the real breakout happens. The specific tell that this is institutional positioning and not a failed pattern is in the volume signature. Look at the volume bars during this morning's spike. Massive volume on the move up to $82. Even heavier volume on the reversal back down. That's not retail panic. That's large blocks being transacted. That's positioning. Now look at the volume during the pullback from $82 to $76. It dropped off significantly. Low volume on a pullback after high volume on a spike means the sellers aren't pressing. They're not chasing the price down. The move down is purely technical profit taking, not fundamental selling. That's the signature of a bull flag compression that's about to resolve higher. Here's the mathematical part that makes this more than just hopeful pattern recognition. When you measure the height of the initial flagpole, that $11 move from $68 to $79, technical analysis gives you a measured move target. You take that $11 and add it to the breakout point. If silver breaks above $79 and holds, the measured move target is $90 per ounce. If it breaks above $82 and holds, the target extends to $93. Now, I'm not saying silver will definitely hit those levels. Pattern targets are guides, not guarantees. But what I am saying is this. The math embedded in this pattern points to significantly higher prices if the breakout confirms, and the fundamental backdrop supporting this technical setup makes it more than just lines on a screen. If you're tracking this analysis with me so far, hit that like button. It tells YouTube to show this breakdown to more silver investors who need to see this pattern before it resolves. Now let me show you why the fundamentals make this pattern more dangerous than it looks. The reason this compression pattern is forming right now isn't random. It's a direct response to what's happening in the physical silver market. While paper silver on the comex is consolidating in this tight range, physical silver premiums have been exploding. In India, physical silver bars are trading at a $7 premium over spot. In Germany, the premium is $5.80. In Singapore, $6.20. Those aren't normal premiums. Normal premiums are $1 to $2. What you're seeing is the physical market pulling away from the paper market. The real price of silver that you can actually hold in your hand is already above $82 in most of the world. The paper price is lagging because of the compression pattern we're watching. But compression patterns don't last forever. Eventually, price discovery forces the paper price to catch up to the physical price. And when that happens, the move is violent. That's the fundamental fuel underneath this technical pattern. That's why this isn't just chart astrology. Now let me show you the historical parallel that makes this setup even more compelling. The last time silver formed this exact pattern at this position in the market cycle was October 2010. Let me walk you through what happened because the similarities are almost eerie. In September 2010, silver was trading around $19 per ounce. It had been in a steady uptrend since the 2008 crash, but the move had been orderly, predictable. Then in late September, silver started consolidating in a tight range between $20.50 and $22. Higher lows, lower highs, classic bull flag compression. On October 14, 2010, silver spiked to $24.30 in Asian trading, then reversed hard back to $22 within hours. Every analyst at the time called it a failed breakout. The mainstream narrative was that silver had topped. Retail investors sold. 3 weeks later, silver broke above $24 and never looked back. By November 9th, it was trading at $29. By January 2011, it touched $31. By April, it peaked at $49. That initial fake breakout to $24.30 wasn't a failure. It was the final shakeout before the real move. Now look at what we're seeing today. Silver has been in a steady uptrend since late 2024. The move has been strong but orderly. Starting May 4th, it began consolidating in a tight range. Higher lows, lower highs, bull flag compression. This morning it spiked to $80 in Asian trading, reversed hard back to $76 within hours. The structure is identical. The narrative from mainstream analysts today is the same as 2010. Silver topped. The rally is over. Take profits and move on. Here's what most people miss about the 2010 setup. The reason that pattern worked wasn't just technical, it was fundamental. In 2010, global central banks had just begun the largest monetary expansion experiment in modern history. Quantitative easing was accelerating. Currency debasement was the quiet policy. Silver wasn't rising because of industrial demand. It was rising because investors were front-running the currency crisis they saw coming. The bull flag compression in October 2010 was the market pricing in two competing forces: momentum buyers pushing higher versus skeptics taking profits. When the breakout confirmed, the skeptics were wrong. The momentum buyers were right. And the move that followed was historic. Now let's talk about today. We're in May 2026. The Federal Reserve has expanded its balance sheet to levels that would have been unthinkable in 2010. The U.S. national debt is accelerating past $37 trillion. Deficit spending is over $2 trillion annually. But here's the part that makes today's setup more compelling than 2010. In 2010, most investors didn't believe the currency crisis thesis. It was fringe. Conspiracy theory territory. In 2026, it's consensus. Every institutional investor understands that we're in a currency debasement cycle. The debate isn't whether it's happening. The debate is how to position for it. That means the pool of capital that could flow into silver as a monetary hedge is exponentially larger today than it was in 2010. In 2010, silver went from $19 to $49, a 2.5x move. If silver follows the same pattern structure from today's $76 base, a 2.5x move would put it at $190. Now I want to be very clear, I'm not predicting $190 silver. I don't have a crystal ball. What I'm saying is the pattern structure we're seeing today is the same pattern that preceded the largest silver move in the last 15 years, and the fundamental conditions supporting that pattern are stronger today than they were then. The 2010 parallel gives us a roadmap, but it's not a guarantee. Here's what actually matters: the next 48 to 72 hours, because every bull flag compression reaches a resolution point, and we're sitting right at that point now. Let me bring this back to what it actually means for you as a silver investor right now. If you're watching this and you're trying to decide whether to buy, hold, or sell, here's exactly what to watch. First, watch the $79 level. That's the previous high from May 4th. That's the upper boundary of the compression pattern. If silver breaks above $79 and closes a 4-hour candle above that level, the pattern confirms bullish. The measured move toward 90 pluses becomes active. If silver fails at $70 and drops back below 75s, the pattern breaks. The consolidation likely extends another week or more. Second, watch the volume. Breakouts on low volume fail. Breakouts on high volume follow through. If silver pushes above $79 on volume, that's at least 1.5x the 20-day average. That's confirmation. That's institutional buying, not retail hope. If volume is weak, be skeptical. Wait for the retest. Third, watch the dollar index. Silver and the dollar have been inversely correlated for months. When the dollar drops, silver rises. Right now, the dollar index is sitting at 101.80, right at a key support level. If the dollar breaks below 101 in the next few days, that removes a major headwind for silver. The breakout becomes much easier. If the dollar bounces from 101 and pushes back above 102.50, that creates resistance for silver. The pattern might need more time. Fourth, watch physical premiums. I mentioned earlier that physical premiums are already at $5 to $7 over spot in most markets. If those premiums expand further, if you start seeing $8, $9, $10 premiums, that's a signal that physical demand is overwhelming supply. The paper price will have to catch up eventually. If premiums compress back toward $2 to $3, that means physical demand is cooling. The breakout thesis weakens. Now here's the honest part most YouTubers won't tell you. This pattern could still fail. The 2010 parallel could be wrong. The measured move could be invalidated. Silver could break down instead of breaking out. I don't know the future with certainty. Nobody does. What I do know is this: the risk-reward setup right now favors the bulls. If you buy silver at $76 with a stop loss at $73, you're risking $3 per ounce. If the pattern confirms and silver moves toward the $90 measured target, you're gaining $14 per ounce. That's a 4.6 to 1 risk-reward ratio. Even if the pattern only has a 50% chance of working, the math favors taking the trade. For those of you who already hold silver and aren't trading around the position, here's what this pattern means for you. You're sitting in a compression zone. The price isn't moving much day to day. It's frustrating. It's boring. But compression zones are exactly where the big moves start. The investors who sold during the October 2010 compression at $22 missed the move to $49. The ones who held through the boredom and the fake breakout captured a generational return. If you're a long-term holder, this pattern is telling you to do nothing. Don't get shaken out by the chop. Don't panic, sell on a fake breakdown. Let the pattern resolve. For traders, here's the playbook. If silver closes above $79 on strong volume, add to long positions. Set stops at 76 arcs. Target $85 first, then $90. If silver fails at $79 and drops below $75, step aside. Wait for the next setup. Don't force a trade in a broken pattern. If silver chops between $75, $79 for another week, reduce position size. The compression is extending. The breakout will come, but the timing is uncertain. The key is to let the market tell you what it's doing. Don't impose your bias on the chart. React to what actually happens, not what you hope will happen. Now I want to hear from you. Are you buying this dip to $76? Are you waiting for the breakout above $79 to confirm before adding? Or are you stepping back until the pattern resolves? Tell me your strategy in the comments. I read every single one and I'll respond to as many as I can. Let me wrap this up with the key takeaways. Silver spiked to $82 this morning in Asian trading, then pulled back to $76 where it's consolidating right now. That move wasn't random. It's part of a bull flag compression pattern that's been forming for 11 days. The same pattern appeared in October 2010. 3 weeks after a fake breakout, silver began a move that took it from $22 to $49 over the next 6 months. The fundamental conditions today, currency debasement, physical premiums, institutional positioning, are stronger than they were in 2010. The pattern is telling us that a resolution is coming in the next 48 to 72 hours. Watch the $79 level, watch the volume, watch the dollar, watch physical premiums. Those 4 signals will tell you whether this compression breaks higher toward 90 plus or fails and extends the consolidation. For holders, this is a moment to stay calm and let the pattern resolve. Don't get shaken out by the chop. For traders, this is a high probability setup with clear entry and exit points. Manage your risk and let the market tell you what it's doing. The investors who panic during compression patterns miss the moves that follow. The ones who stay patient and read the signals carefully are the ones who capture the real opportunities. Subscribe to John Asian Guy and hit that notification bell so you don't miss the follow-up when this pattern resolves. I'll be tracking this setup hour by hour. Hit the like button on your way out. It genuinely helps this analysis reach more investors who need to see it. And drop your strategy in the comments. I want to know how you're playing this setup. The next 72 hours are critical. Don't look away now. I'll see you in the next one.